Hey everyone. Chapter 3 is going to talk about the basics of finance and how the finance department and HIM work together as part of the revenue cycle. Okay, in the US, the system that pays healthcare organizations and doctors is very complex, partly because, as you now know, there are so many different reimbursement methods. But also because healthcare is a business, right? So it operates on making money, but it doesn't sell a product, it sells a service. So that adds even more complexity. So today we're going to talk about organization types, revenue, expenses, assets, liabilities, net worth, and managerial accounting. Feel free to take notes if you'd like, or you can just come back to this video when you're studying for the midterm. So an organization's financial structure depends on what basic type of organization it is. Is it profit or nonprofit? I'm sure you've heard of nonprofit organizations before. This refers to the tax status. Profit-oriented organizations are also known as proprietary organizations, mean that they are privately owned and responsible for paying income taxes. Nonprofit organizations do not pay taxes. There are two types of nonprofits. We have voluntary nonprofits where they've applied to be tax exempt, usually associated with churches or private schools or foundations. And then government nonprofits, they do not pay taxes because they are government entities. They'd be paying the money to themselves. So this would be federal, state, county, city, or university teaching hospitals. Managers in a healthcare organization are going to have different viewpoints of finance depending on what department they're in. So, for example, the CFO, or Chief Financial Officer, works with financial data every day. So they have a financial view. Whereas the HIM manager, who's dealing more with inputting data in the information systems and documentation and data accumulation, has what's known as a process view. And then the DON, or the director of nursing, who's responsible for, all of the nurses, so direct care with patients, they would have a clinical view. Okay. Revenue refers to the amount of money an organization earns, which in healthcare, as we all know, is earned by providing services to patients. So revenue represents an inflow, the money coming in. In the financial statements, revenue is recorded at its full amount, so the total amount that is charged to a health insurance plan. But insurance companies don't ever pay that full amount. So the estimated amounts that they don't think they'll receive are recorded as deductions from revenue. Okay, when an organization has a contract with an MCO, they have the contractual rates that they negotiate, what the MCO is going to actually pay for services. Contractual allowances refers to the difference between the full rate that they charge and the contractual rate that the MCO is actually going to pay. Each health plan can have different contractual rates for the same service at the same organization. It just depends on what they negotiate. So these contractual allowances are considered a deduction from revenue. Okay, an example that a hospital's established rate for a procedure can be $100, but the managed care plan's contractual rate for that procedure is $90. So the contractual allowance, the difference for that procedure, would be $10. Okay. Moving on, when managers are planning their budgets for the year, for the next year, right? A lot of times they'll group revenue by classifications. And one of those grouping classifications is by revenue center. This is a department or a unit that brings in revenue. Okay. The second classification is by care setting, which is the different locations that the care is provided. And the third is by service line, which groups similar services together. So like all surgical revenue is in this service line, all pediatrics in another, etc. Revenue comes from financial transactions. So this is the exchange of goods or services for a payment or a promise of payment. So there are three broad or general steps in a financial transaction. First, the service is provided. Second, a transaction is recorded. And finally, compensation is exchanged. Obviously, there are a bunch of steps within each of those three steps that are performed by different people and departments to make the financial transaction happen. So we're going to talk about these four main functional departments. Okay, so clinical services is providing the actual patient care and doing the documentation in the record. They're also responsible for the input of all the billing information in a large database known as a charge description master. This lists like all of the internal revenue codes, the HCPCS codes, like descriptions of what the service is, and then how much they're charging for each thing. But we'll actually talk about the charge description master in another chapter. Okay, the Health Information Management Department, as you know, assigns the correct codes, which drives reimbursement. HIM also collects and maintains the records that have the documentation to support the reimbursement. So we charge this much because this is what it says in the record. Okay, the third functional department is patient accounts. This depends on the clinical services and HIM departments to input reliable information so that they can bill the payer to get reimbursement. And then last is the financial department. They analyze all the financial data to track the reimbursement, to try to control costs, forecasts, plan for future activities, things like that. It also manages like paying employees and purchasing new equipment and supplies, okay? All right, so that was all revenue. All right, if revenue is the amount earned and represents the inflow, right, money coming in, expenses is the opposite. It represents the outflow, money leaving. So these are the costs related to earning the revenue, okay? Putting it simply, you have to spend money to make money, right? Now, make sure you do not confuse the word cost with the word charge. Okay, charges are revenue. If you remember, that's what's created after a patient encounter, right? The charge will drop. Costs are expenses. Okay, so don't confuse those because it is kind of confusing. So charges add in money, costs take away money. All right. Let's see. And remember how revenue is grouped into revenue centers? Costs are grouped into cost centers in the same way. So a cost center can be a department, a division, or an office. And managers in each of those cost centers are in charge of keeping the costs low in their department or their office or whatever. Okay, made it through that slide. All right. Other than revenue and expenses, we have to also look at assets, liabilities, and net worth. Assets are resources that the organization owns or is due to receive. So this would be cash that they have in their bank accounts, all of their inventory, all of the supplies that they use to provide services, accounts receivable. Remember, this is the money, that they have earned but haven't received the actual payment yet. the physical building that they operate in, and equipment like CT machines, computers, etc. Okay, that's all assets. Liabilities are debts. So this is what the organization owes to other people or other organizations. So this would include accounts payable. This is the opposite of accounts receivable, right? This is the amounts the organization owes for goods and services that they have received. You know, like if someone did a service for them, but they haven't paid for it yet. Okay. Also, loans payable. That's what the organization has borrowed and will repay over a period of time. And then net worth is the owner's equity, or what the organization is worth after the liabilities are subtracted from the assets. Okay. These three things are documented on the balance sheet, the income statement, the statement of owner's equity, and then the statement of cash flow. Your textbook goes into a lot more detail about those four things, but you don't need to know that for my class. All right. To get the proper amount of reimbursement, organizations have to also keep track of what resources or supplies they're using when they provide services. That's what managerial accounting is for, to make decisions based on reports that are created to track what resources are used. So the data in these reports would include the costs. Okay, so we already said costs are expenses. Well, there are different types of costs. Direct costs are costs used by a specific department. So if that department didn't exist, would the organization still have that cost? If not, then it's a direct cost. If it would still exist, then it would be an indirect cost. These are costs for the overall operation of the organization, not just one department. So for example, a direct cost for HIM would be payroll for medical coders. An indirect cost for HIM would be the electricity for the department. Okay, that cost would be there whether HIM was there or not. Okay, then we have fixed costs, which stay the same even if there's a change. An example of that would be a nurse's salary. It would stay the same whether the hospital beds are fully occupied or only half occupied. Okay, it's a fixed cost, whereas a variable cost does change with volume. So as the number of patients who are treated increases, the amount of medication used from the pharmacy would also increase. Okay. Budgets are another important responsibility that managers have when it comes to financial accounting. Budgets are used to forecast, so to kind of predict revenue and expenses for a department or organization. So this year, they're going to set the budget for next year. They do it, in advance. And the goal is for their department to stick within that budget that next year, right? So this process begins with an organization's board of directors. They're going to set the overall budget for based on past income, past expenses for the whole organization, and then each department will get a chunk out of that overall budget. The goal is for revenue to be met or exceeded, okay, higher than expected, and for expenses to be met or lower than what they budgeted for. Sometimes when revenue is exceeded, then expenses can increase as well. Like if your hospital has an unplanned increase in the number of patients, then your income, your revenue is going to increase. But it's also going to cost more money now because of the extra supplies used to treat these extra patients. So expenses are going to increase also. This is called variable expense. Okay. The most common type of budget is the fixed budget. The budget amounts are a set number based on expected capacity and don't change even if the capacity changes. A flexible budget is adjusted depending on capacity. Okay, I've talked about variable costs and now variable expenses, so you probably have an idea of what variance means by now. Variance is the difference between the budgeted amount and the actual amount. Okay, budget variances can be temporary or permanent. Permanent meaning it won't resolve itself in the current fiscal year, that current budgeted for year. It's also important to know if it's favorable or an unfavorable variance. A favorable variance is when the actual results are better than what they budgeted for. So maybe their expenses weren't as high as they thought, so they ended up making more money overall. An unfavorable variance is the opposite. The actual results are worse than they budgeted for. So usually each month, managers have to put out their monthly budget report where they have to explain all of the budget variances and whether they're favorable or unfavorable, and if they're temporary or permanent. Okay, let's see. An advanced beneficiary notice, or ABN, is a Medicare liability waiver that doctors have to give patients for services that aren't covered or that are not considered medically necessary by Medicare. This is not used by commercial health insurance companies, just Medicare. And also, it can't be given to a patient that is receiving emergency treatment. Okay. If the doctor informs the patient that the service won't be covered, and then the patient signs the notice, then the doctor can bill the patient. Let's say a patient pays for a service up front, and then because they think that Medicare is not going to pay, but Medicare actually pays for part of it or all of it. Then the doctor has to refund the patient within 30 days, or they could get in trouble. If the doctor doesn't issue an ABN, or should have known that Medicare is not going to pay for the service, then the doctor has to take on those costs. They cannot bill the patient. And the reason, this can't be used in emergency situations is because, the patient may not even be able to understand what they're explaining to them, right? They could just sign something not knowing what they're signing is saying they're going to have to cover all the costs, right? Okay, CMS has regional contractors called Medicare Administrative Contractors, or MACs, that process Medicare claims. Each MAC is actually a private health insurer that gets a specific region of the country to deal with Medicare Part A and Part B claims. So on top of claim payments, the MACs send out remittance advice, or RAs, to providers that explain the payments. So this is the communication from payer to provider. And we've talked about this, I think, in chapter 1 or 2 a little bit, but these RAs will have multiple claims on one thing that has what each patient's coverage is, what their copays and co-insurances are, if there's any adjustments, and then how much they're paying to the provider. Okay. There are remittance advice remark codes, or RARCs, on the bottom of the form that explain in more detail why an adjustment was made, or just to relay messages. Like if they don't have a certain code for something, they can put it in these RARCs. And the explanation of benefits, or EOB, is the same thing, but on the patient side. So that's the payer telling the patient what the total charges were, how much they paid, what the patient's deductible and co-insurance is. It's not a bill, but it can put on there what the patient will be expected to pay. The bill would come later, right, from the doctor. So the Medicare EOB is called a Medicare Summary Notice, and it's basically the same thing. It just has a slightly different name. Okay. All right. You can see here the Healthcare Financial Management Association's definition of price transparency. In healthcare, readily available information on the price of healthcare services that together with other information helps define the value of those services and enables patients and care purchasers to identify, compare, and choose providers that offer the desired level of care. Okay, we all want to be knowledgeable consumers, right? Especially, since deductibles and out-of-pocket expenses are going up. So to help with this price transparency, CMS created the Hospital Price Transparency Rule in 2021. So this rule was to give patients the necessary information to make informed decisions about their health care. Because there wasn't a way for us to easily access pricing information before. A key part of the rule is that standard charges have to be presented in two ways. So in a machine-readable file that lists these charges. So the gross charges, this is the total charge for an item or service without any discount. The discounted cash prices, so if you pay with cash in full, it's usually a little bit cheaper. The payer-specific negotiated charges, like what each third-party payer negotiated price is, and de-identified minimum and maximum negotiated charges. So this is the lowest charge the hospital negotiated with all of the third-party payers for an item or a service. The other way, the second way it has to be presented is in a consumer-friendly display of shoppable services. Shoppable services are ones that you can schedule in advance. So not emergent treatment, right? These are, things that are planned ahead of time. Okay, even though it seems simple enough, hospitals have had trouble meeting the CMS requirements for price transparency. The first challenge has been to publish standard charges for all items and services on a prominently or publicly available website. Some healthcare organizations have several hospitals and clinics or outpatient facilities under one umbrella. So each entity would have to make these lists of charges. So it can take a lot of work, a lot of manpower. Another thing that has to be available on the prominent or publicly available website is a price estimator tool. So consumers can find out what they would have to pay for a service that they're considering. To be fully compliant with this, hospitals have to update the standard charges at least once a year and have on there when it was last updated. Excuse me. If they're not compliant with all of the requirements, they can be charged a fine up to $300 a day. And CMS is auditing the websites because they want that money. And providers agree that price transparency should be a thing. They just don't agree with the method that CMS is requiring. They feel that it would be better to have some sort of customer service department where the patient is given like a personalized estimate based on their health insurance plan. And then the patient can ask questions and they can just do a better job of, provide a better customer experience that way instead of a patient, getting frustrated trying to use this website that has a bunch of descriptions and codes that most people don't understand. Okay, so the solution is probably somewhere in between, and hopefully they figure that out sooner rather than later. And that is all I have for you today. Now you can go and complete your bell ringer questions. So good luck.